Welcome back everyone to the Money Control live stream. You're watching another edition of Markets with Santo and CJ. And well, we have a strong end to the July derivative series on our hand, with the benchmark indices all set to snap a 3-month losing streak at this point of time. If you look at the Nifty and Sensex, they're sitting pretty at about 11-week high, higher by about 1.5% each, and led by a lot of short covering as well as positive cues from the global markets. If you look at some of the big, stocks and sectors that are dragging the index higher, they are IT, they are banks, and they are RIL. And of course, these are the three counters we had seen the maximum amount of short positions happen during the month, Santo. So it's no surprise there that ahead of the expiry, we are seeing some squaring of a position from traders, and that is reflecting in the stock price as well. So generally a very, very strong end, Santo, to a July series that, at the beginning of it was looking quite murky.
Well, yes, and CJ, I just wonder, did I mishear it? Probably, is it a 75 bips cut that the Fed has announced? I think that seems to be...
No, I think it is a hike. We definitely can confirm that.
So, the market decided to read the positive, side of whatever...
When you're beaten down to death, sometimes every small thing becomes a more,
Yeah, you're cherry picking, the best parts there,
exactly,
and you hear what you want to hear. I think that
possibly.
Exactly is the case. But that said, CJ, this is more of a trader's market at this point. Just look at the prices of mid-cap stocks.
Yeah.
Okay, if you were to compare them, the prices about, let's say, 6 months or back, the prices have not really gone anywhere, and in many cases, in fact, it's still lower.
Okay.
That's the case with most of the fancied names, which were at really, which had seen a huge run up last year. So those stocks have not really performed. So the breadth of the rally, I think, that has become very, very narrow. So you have to really be in the right set of stocks to be able to benefit from this rally.
That's it, Santo. I mean, if you look at the Nifty small cap, mid cap, and Nifty 50, they are all higher by almost 11 to 16% since mid-June. So almost in almost 6 weeks, we have covered a lot of ground from the 52-week lows that we had seen on all the three indices in mid-June. So clearly there is some momentum building up here. The important thing would be that, in the past, where we have seen bear market rallies where indices have gone up even as much as 25%, only to then fall another 35-40%. So clearly that will be the tricky business here, whether it's the beginning of a new upswing for the market or just a dead cat bounce. I guess we will have to wait.
We'll only know that in
Yes.
hindsight. Well, with that, let's take a look at the stocks on our watch list this afternoon, starting with Bajaj Auto. CJ, a decent set of numbers there. Stock has not really reacted to it, but it's had a fairly good run so far this year. It's still up a little over 10%, 10 to 15%, and it's been among the stocks in the auto sector, which nobody really being in the two-wheeler sector, nobody really expected the stock to do still well, and it still managed to do that. And now you have analysts sounding positive after the company's quarterly earnings. You have CLSA saying that the chip shortage is easing and the volume outlook is improving. Jefferies is saying that two-wheeler sector as a whole is poised for a cyclical revival.
Right.
And it's also highlighted the fact that gross profit per vehicle has risen 4% quarter on quarter. This is the highest in many quarters. So things seem to be looking up for Bajaj Auto at this point in time. Now, hard to say whether market has factored in a lot of that, given that the stock has had a good run in a volatile market. But clearly downsides look limited at this point.
Yeah, I mean, Santo, of course, the stock has also been supported by the fact that the company came out with a buyback not so long ago. So clearly that is something that will support valuations in the near term. But if you look at the earnings performance, one of the reasons why Bajaj Auto was outperforming within the two-wheeler space is the fact that for it, the domestic market was not really that big a problem, because it was getting a lot of orders and a lot of revenues from the export market. Now, over the past 3 months, I think that export story has hit a handbrake. If you look at sales,
there are no handbrakes in a two-wheeler. I mean, that's the
exactly my point. But it has at least hit a very major speed bump. If you look at the African business, is the two-wheeler sales there are down on a sequential basis. Three-wheeler sales are down almost more than 50% on a sequential basis for the Africa region. Apart from that, even Southeast Asia, other countries like Sri Lanka, which are major markets for the three-wheeler side of the business, have really suffered. Now, the management has indicated that probably some of the Southeast Asian market demand is recovering, led by Philippines. But I think Africa is the major point of concern, because there is a shortage of US dollar at this point of time because of the withdrawal of global liquidity, and a lot of countries are struggling to import a lot of goods. And I think Of course, if you look at if you have to choose between a two-wheeler and a necessity, I think a lot of governments would rather choose necessity. I think that is where a bit of a concern can come in for Bajaj Auto on the volume front. And as I said, three-wheeler is something that we have to watch out for, because that was a very good driver, and also it's a high margin business. So therefore, that could affect margins. Although you would expect the softening in commodity prices could have some sort of tailwind in the second quarter.
Well, quick point, in fact, most of the broking firms which are still positive on Bajaj Auto after the earnings, the price target is in excess of 4,000. Besides that, they have flagged the slowdown in exports. In fact, all of them have cautioned that export is a slightly weak spot, but despite that, and they have accordingly trimmed their EPS slightly, but despite that, they still continue to be.
Yeah, I mean, I think the bet would be that India will recover so fast that probably it will be able to offset a lot of what is happening in the global, in the export business. That said, another stock which came out as a surprise package, even though it has been beaten down by the market left, right, and center, is Jubilant Foods. I mean, very, very good set of numbers. Very, if you look at most metrics, it was better than expected, except for a few, including the net profit number. So, the one thing that stood out, of course, was the like-for-like same-store sales growth, which came in at 28%, which was above a CNBC's poll of about 26 to 27%. And I think that is the major reason which has lit up the fire in the stock today, Santo.
Well, CJ, just explain that like-for-like store part.
I mean, it's basically, it's what it means is like if you have stores across the region, you smoothen it out to ensure that your sales are, you're matching or comparing sales on a like-for-like basis. So that way there is no discrepancy in data, right? It can happen that you might have stores in Chennai, might have stores in Mumbai, and might have stores in Delhi, and it could lead to discrepancy in sales. But this way you smoothen out the data and you give a like-for-like comparison as to what will happen if the stores were almost same to same or side by side. So that is something that a lot of analysts look out for. Remind you, in between, this was the major reason for a lot of analysts to become bearish on Jubilant Food, because you remember last year only when they had embarked on a new strategy wherein they wanted to probably open stores very close to each other, and everybody started thinking, wouldn't that eat into your revenues of one store? But clearly, I think it has not really affected, that strategy is not really affected, and it has worked out for the management. Apart from that, the commentary of the management also seemed quite impressive. They were very excited, according in their words only, they were very excited for the year that lay ahead after record revenues in the June quarter. So clearly, they are not seeing any sort of demand issues that a lot of the market was concerned about, because if you look at the stock performance, it's down about 21% despite the almost 4% jump today.
Well, CJ, exactly. It's hard to quibble with the numbers. I can say that over the last 3 quarters, if you see the sales numbers have not seen a very big jump. It was about 1,200 plus crore in December quarter.
But probably mitigated by the fact that we also had COVID, Santo. So maybe that is also what might have affected it.
Well, even if I take that, that seems to be something which is weighing on the minds of investors at this point, because if you see from the starting of the year, the stock has been under pressure. QSR space and the fact that now you have a wide range of stocks to select from. Till some time back, you just had Jubilant in that space. So always the stock used to command a very high premium compared to other stocks, but that is no longer the case. So when investors see any signs of growth slowdown, probably they try to hop on to the next stock, which looks even better.
But we will have to wait and see, of course, if other QSR companies, deliver same sort of earnings. Then maybe there could be question as to whether I want to buy Jubilant, which is more premium valuation than, say, for example, a Burger King's in that range,
Well, VIP Industries, good set of numbers there again. CJ, top line as well as margins, both are at 12-quarter highs. Now, this is an industry which was hit very hard by the COVID lockdown, along with aviation and hospitality. Travel also took a big beating. So that was reflected in VIP's numbers for the past many quarters. But finally now, the company appears to be coming out of it. More than just the top line growth, the fact that the margins in a very competitive environment, the company has managed to hit margins which is the highest, 17%, which is the highest in almost 12 quarters. That also shows the cost discipline of the company. This is a stock which is still, among the best performers of FY22, FY23, I mean to say, and this should continue for some more time, given that you are only likely to see travel pick up here on.
Well, Santo, I think I don't have any qualms with VIP's numbers. Of course, they are very good if you look at it from a year-on-year basis and even on a quarter-on-quarter basis. But I think the commentary is something that worried me a little bit, wherein the management has, said that high inflation is already starting to take a toll on consumer demand. Now, of course, VIP is has not been spared by high input costs, so they have tried to pass it on to some of that cost to customers, and clearly that is now affecting demand in that way. If you look at what the manager had to say, clearly towards the end of the quarter they saw some sort of slackness in demand. So I think that for me could become a concern, especially in the September quarter or the second quarter of this FI, and we will have to wait and see if costs come down. Maybe they might be able to provide relief, but generally that corporates, once they raise prices, it's very difficult that they will immediately bring it down if costs come down. So clearly something to watch out for. And apart from that, Santo, another commentary that came in from them is the fact that they suggested that business travel has been on a slow recovery path, and it has not recovered in the same way that you have seen recreational or a vacation travel improve. So clearly that is something to watch out for. And also we don't have the wedding season anymore in the September quarter, so probably I would expect some sort of weakness on a sequential basis in earnings for VIP Industries. Well, what last talk on my radar was DB Corp. Breakout earnings for the company in Q1. Clearly a sunset sector that nobody really expects to do well, and also
that's the argument I was about to make.
Yeah, possibly, yes. I mean, newspapers, nobody talks about newspapers anymore. I mean, we ourselves are digital, so that way it's a little surprising to see such a great earnings performance from Dainik Bhaskar. Remind you, a lot of it is also being led by their digital initiatives. Their digital business has seen almost 100%, more than 100% year-on-year growth from the previous year ago quarter. So clearly, a lot of levers in the business are working out. If you look at the standout metrics, clearly the operating performance and the margins are something that really stood out for me, Santo. There has been an expansion in margin despite the fact that newsprint costs have actually been rising for the past 2-3 quarters, and that is why paper stocks were rallying so much throughout this year. So clearly the cost efficiency that the company is displaying is very good, and I think in their commentary also they have suggested that they are very confident that margins will keep on expanding from here on. So clearly this is not a one-off quarter wherein they have seen a good margin performance. So a stock, probably you have seen the reaction already from the market. The stock really blasted off after the earnings came out, and I would expect that this momentum will probably sustain at least in the near term.
Well, CJ, my quibble with DB Corp is that it's not been a wealth creator for shareholders over the longer term. If you look at the stock since listing, if you still happen to hold on to DB Corp share, then you won't be very pretty looking at your portfolio.
Possibly, yeah.
And again, as far as if you look at the trend in quarterly earnings, it is still to get back to pre-pandemic levels. You've seen much better numbers in the previous quarters also. And it's been pretty much range bound there, no big breakout really there. You mentioned that. And when you talk about operating margins at 14%, for this quarter is still very low compared to the 26, 25 plus margins it used to enjoy in the past, right? So either it needs to really grow its top line in a big way, so that even with that slightly reduced margins, a lot of it will feed into profitability. That, at least for the time being, doesn't seem to be appearing. And again, this stock, from its pre-pandemic lows, it was about 60 rupees, and today it's about 80 odd rupees, 80 plus. The stock price has also not really shown that kind of an appreciation which you've seen in most other stocks.
I think, Santa, when you talk about the top line, I think the one comment that really stood out for me is the fact that the management has indicated a circulation in general for Dainik Bhaskar has gone up 4% on a year-on-year basis, which is a surprising, incident, because generally you are not seeing newspaper circulations go up for any of the players out there. So clearly, the initiatives that the company is taking on the institutional side as well as on the direct consumer side clearly are paying off, and I would not be surprised if the circulation numbers keep on inching higher and then contribute to the operating revenues as well. And I think as far as the operating margin is concerned, I think we are now seeing a recovery here than a downtick, because of course 25% margins were a different era when newsprint costs were much lower. In the past 2 to 3 quarters, we have seen newsprint costs jump up almost double on in that time frame. So clearly that is going to eat into your profitability, but clearly if they are taking cost control measures, then margins should recover. Whether it will go back to 25 is anybody's call, but I think market would be happy to see that recovery path.
The last stock on our watch list today is Shree Cement. The company reported its first quarter earnings and see a very disappointing set of numbers, and that's generally been the case with the cement sector. So net profit is down about 52%, your operating profit is down about 19%, margins are at 19.5% versus 24.4%, and the biggest spoiler has been the increase in power and fuel costs, and that seems to stay for a while. Now club this with the fact that there is going to be overcapacity not before long, and then you have the recipe for further pressure on the stock price.
Well, I think one way to place Shree Cement Santo could be a tactical bet, given the fact that a lot of analysts have been talking about the fact that cost pressures for the cement sector could have peaked in the June quarter because fuel costs on a sequential basis have come down. You have a lot of raw material costs have also come down on a sequential basis. So there is an expectation that probably Q2 and Q3, you could see some bit of sequential expansion in margin. And I think that is what something that market would probably look at beyond the Q1 numbers. Apart from that, analysts are also quite bullish about the fact, and this is something that was mentioned when Ultratech's earnings came out, that volume recovery could happen for the sector in H2 because of the fact that government capex will accelerate. We have not seen government capex accelerate very meaningfully so far in the first 4-5 months of this FY23, and with the end of the monsoon season, once the construction season actually starts from October onwards, we could see a very sharp pickup in volume and hopefully rural area volume, because we will be expecting that rural demand really drives growth going ahead. So those are the two things that I will look out for. And on the valuation front, clearly Santo, I mean, we have seen almost a 22% decline in the stock in the past 3 months, and I would assume that should make valuations quite reasonable for investors out there who are looking to take maybe a tactical 12-month view on the stock.
Well, one thing, it's just not for Shree Cement, but in general, a lot of comparison is done with the peak prices till some months back. Now, I'm not sure whether that's the best way to look at things when there is an overall change in the earnings outlook as well, CJ.
Absolutely.
Well, that said, what's on your radar?
Well, Santo, earnings, of course, SGFC, Sun Pharma, we have Cipla, so 3 big nifty earnings coming out. Apart from that, there are other nifty stocks such as NTPC and Indian Oil, so overall 5 nifty earnings coming out for the June quarter tomorrow, in tomorrow's trading session. And of course, one real estate name, DLF, something to watch out for after macro tech developers, very strong earnings. It will be interesting to see how DLF earnings performance is. And apart from that, of course, on the economic front, you have the US Q2 GDP data coming out later in the evening. And tomorrow we will have the June inflation data coming out. So clearly a lot to, digest for the market, not only in terms of earnings, but as well as economic data.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thank you for watching, and please do share your feedback on the show in the comment section below.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again live tomorrow morning at 9 a.m.